Hello, listeners, and welcome back to Gyeongjae Young, The Deep Dive. Our goal here is always to break down the key financial articles from the Seoul Economic Daily, giving you clear, actionable insights. Today, we're looking at two really big financial currents moving maybe in opposite directions. First, there's this huge new 5 trillion won government fund aimed at boosting industries that, well, often get left behind. And second, some worrying signs in banking health. Non-performing loans are up, and the safety cushions look thinner.
Yeah, it's definitely a critical moment. We're seeing the government trying to build for the future, create resilience. But at the same time, we're observing these growing vulnerabilities right now in the banking system, looking at the source material, this push for new investment. It seems like a direct response, a recognition that just focusing on high tech isn't enough, leaves too much of the economy vulnerable. Let's start with that new policy push.
Right, the Financial Services Commission, the FSC, they're setting up this 5 trillion won scale-up fund over 5 years. And the key thing, as you mentioned, this is separate. It's not the big 150 trillion won National Growth Fund, the NGF.
Exactly. And it's not just about the amount, it's the targeting. The plan starts with 500 billion won from the government starting 2026, then leverages KDB, Korea Development Bank, and private money to hit that 5 trillion total. But the why is crucial. The NGF, it's legally tied to specific advanced tech, semiconductors, bio, AI, batteries.
So if you were a solid company, maybe growing,
Yeah.
but in a more traditional sector, you could just fall through the cracks. No policy funding.
Precisely. That's the gap. The scale-up fund, it's aimed at that vital middle layer, often ignored by VCs too. Think traditional shipbuilding, marine tech, materials, parts manufacturing, environmental industries, even some ICT if it's not AI-focused. Take sophisticated ship tech company if their big innovation isn't AI. Under the old system, well, no NGF money. That's a risk for industrial diversity.
And it sounds like the push for this came right from the top.
Yeah. It certainly sped things up. President Lee Jae-myung really emphasized the public sector needing to absorb some risk here to get private investment flowing in these overlooked areas. It acknowledges that the market alone isn't solving the funding issue, especially for later stage companies. The Mother Fund, the Mote Fund, that's mostly early stage startups. This scale-up fund is different. It's really focused on those later stage venture companies. We're talking investments averaging around, 27 billion won, similar to existing growth support funds, helping them scale up properly.
Okay, and to avoid confusion or duplicated effort with all these funds.
Right, efficiency matters. They're planning to consolidate. The FSC intends to fold the 4.5 trillion won Innovation Industry Fund and the 120 billion won Semiconductor Ecosystem Fund into the main NGF framework. Just streamlines things, makes the focus clearer for where policy capital should go.
Okay, so that proactive 5 trillion won plan for the future. Yeah. It makes a lot more sense when you put it next to the cracks showing up right now in banking. The financial sector seems to be under some real stress.
And the numbers really tell the story there. We looked at the big four banks, KB, Shinhan, Hana, Woori, how they're dealing with the economic slowdown, after all the pandemic support ended. In Q3 alone, just those four banks had to dispose of, get this, 1.533 trillion won in non-performing loans. NPLs.
Wow, 1.5 trillion. And that's up nearly 20% from last year. That's a huge amount of bad debt to clear out.
It is. And it's the trend, really. NPL disposal. It's up 3.5 times since the low point back in late 2022. That acceleration is the signal. The long tail of the economic slowdown is hitting bank balance sheets hard. The average delinquency rate is up, too, naturally, to 0.34%. Woori and Hana were a bit higher, 0.36%.
But you said the safety net itself is shrinking. That sounds like the bigger worry.
Absolutely. That's the NPL coverage ratio. Think of it as the bank's rainy day fund for unexpected losses. And the key insight here, that buffer, it dropped significantly by 12.2 percentage points in just 1 year. Went from 176% down to 163.8%. So the ability to absorb losses is going down just as the bad debt pile is growing. That's not ideal. And Hana Bank's coverage was the lowest of the four, 135.95%. That signals maybe a bit more vulnerability there.
And this pressure, it filters down to regular people too, right? We're seeing it in lending.
Yeah, definitely seeing a tightening. Household lending growth is slowing down. Specifically, mortgages for home purchases growth slowed sharply last month, only up 700 billion won. That's like a 40% drop from September's growth. And look at Gianzi loans, that unique deposit system. We saw the second monthly decrease in a row, biggest drop since April last year. Suggests those government measures trying to curb gap investment might actually be biting.
And then you add rising interest rates onto that tighter credit. That must really squeeze household budgets.
Exactly. Mortgage rates, especially those mixed rate ones, the upper end hit 5.832% last month. That 5.8% isn't just abstract. For homeowners, that can mean hundreds of thousands more won each month, increases default risk, adds pressure, feeds back into those delinquency numbers we talked about.
Okay, so systemic risk seems to be ticking up in the big banks.
Yeah,
But the sources also showed some examples of resilience, right, at the local level, like that Sosu One, Samal Gyemgu story. Quite incredible.
it really is. A great contrast and honestly a lesson in risk management. Formed back after the '99 crisis, merging 5 struggling local unions. Since then, assets exploded from 69 billion won to nearly 890 billion now. They're aiming for the 1 trillion club next year. And the key part, they've kept a top-tier grade 1 management rating for 25 years straight.
25 years, grade 1. While the big banks are dealing with rising NPLs. How? What's their secret?
Well, it seems to boil down to really rigorous hands-on risk management, the kind that maybe gets lost in big macro models. Their system involves mandatory site visits, external valuations for every loan, then a multi-stage review, branch, and headquarters. They even have this unique summary table system for tracking loans, ensures clarity even if staff change. And the result? A delinquency rate of just 2.53%. It shows that local, detailed attention really works. Plus, they do things like free tax consulting for small merchants. Really anchors the community.
That focus on stability and community support.
Yeah.
It echoes in the last example, too, from Hana Financial Group, right?
It does. Hana got recognized recently an appreciation plaque for 8 years supporting elderly care facilities, specifically Sambal Nursing Home. And it's not just, writing a check, it's targeted practical help for seniors, including those with dementia.
What kind of practical help are we talking about?
Things that make a real difference to safety and quality of life. Electric beds, anti-fall mattresses, wheelchairs. Critical stuff. And facility upgrades too, installing proper air conditioning, new flooring, making the environment safer, more comfortable for vulnerable people.
And Hana's efforts go beyond just seniors.
Yes, they seem quite broad. They have this Hana Power and Second Life program helping mid-career and older workers with reemployment or starting businesses. They also support waste resource activists, giving them lightweight carts, safety gear, and importantly, running digital finance education specifically designed for the elderly, trying to bridge that digital divide.
So that wraps up our look today at major financial policy and banking stability trends.
We'll be back soon with more quick updates.
This has been Gyang Jae Young from the Seoul Economic Daily. Thanks for tuning in.